Hi everyone, FinanceFeeds is here at the IFX EXPO Asia event, and I'm joined once again by the lovely James Alexander, who's Group Chief Commercial Officer at 26 Degrees Global Markets. James, it's always a pleasure to speak with you. Thanks for taking the time out of your busy schedule here in Hong Kong to speak with us.
Pleasure. It's always a pleasure. Thank you for having me.
Likewise. So I want to start right off the bat, talk about gold prices, which have surged. Metals now make up a large share of client trading for many CFD brokers.
Sure do.
And knowing that 26 Degrees is a company that provides a lot of services to brokers. Today, I wanted to ask you, how significant is gold exposure among broker clients today and what you're seeing?
Yep.
And what risk does this create in terms of concentration, hedging, or liquidity coverage? And I know we probably touched upon these subjects earlier this summer when we spoke in Cyprus, but maybe you have some updates for us.
Yeah, look, it's certainly true to say that the precious metals market, gold in particular, has been a real focus. That asset price increase is not necessarily something you see regularly. You know, it's been very aggressive. And whenever we have significant asset price increases, it's not surprising to see significant retail participation.
Yep.
To put some numbers around that, from our broker customers, we generally see around 60 to 70% of their flows at the moment are coming through in precious metals, predominantly gold.
Wow.
We've also seen significant increases in silver and the unloved precious metals, platinum and palladium.
I've heard that silver is like making a really bad comeback right now.
It is. And I think, for a while there, the asset price of silver was lagging gold.
Yeah.
And I think that divergence really grabbed a lot of retail attention.
Right.
So there was a significant amount of interest in, I guess, the realignment of those asset prices after gold had run up so significantly initially and silver was a bit of a laggard. Retail participation loves a trade like that.
Right. I was going to ask, is it, you think, kind of like gold, it's not like it's had its run, but it's at all-time highs all the time. So investors are like, well, let's look at some other metals market that might be that might be impacted with price action today. Yeah.
100%. And we've seen this time and time again in different asset classes. But when you see a particular asset, whether it be gold in the precious metals market or even a stock like Nvidia, what we often see is when you get a lot of retail participation in a particular instrument, this is regularly a spillover effect that happens after that. In precious metals, it's silver, it's platinum, it's palladium. In equities, it might be, the Tesla phenomenon that was several years ago has then spilled over into other US equities like Nvidia, like Palantir, etc.
Yep.
So that's not uncommon. But hey, coming back to your question on gold and the concentration risks, they're significant. And it's fair to say that a number of brokers that are both clients of ours and we just have communication with in the industry were heavily concentrated in their exposures in gold.
Yep.
For ourselves, we're very fortunate. We've sort of been blessed with the foresight to work with 6 prime brokers. Now, that kind of capacity planning, which happens a long time ahead of these sorts of events, is absolutely crucial because for us as a provider of not just liquidity but access to credit, access to markets, ensuring we've got more than sufficient credit and access to markets ourselves, that capacity planning with PBs is critical. And look, it's nice to say we have 6 PBs. There's a lot of work that goes into that. And it's a juggle, but that's part of our business. That's part of the service we provide to customers. And it pays off when you've got markets like this and you're able to look after clients in the way that they need that kind of coverage and that access to credit because we've more than covered ourselves. On the liquidity side of things, it gets pretty nuanced because this run up in gold price has also seen significant volatility. Especially around market opens, Monday mornings, Friday afternoons, around news events. We have seen gold spreads widening. That's been something that is, absolutely, unquestionable. But for us, it's really about the consistency of pricing that we can bring, the stability, the reliability. And that comes back to things like, again, it's not the sexiest thing, but quote filtration, correct benchmarking of our LP feeds to make sure that anytime we're presenting a price to clients, whether it be first thing on a Monday morning, last thing Friday afternoon, that we're reflecting the most accurate view of a midpoint, a fair midpoint from the market that we can determine. And that's easy when there's a lot of liquidity coming into the market and things are, consistent.
Right. It is.
Sparse liquidity and volatility.
That's when things get dicey, right?
Gets hard. So you've got to ensure that systems, that processes around filtration, around benchmarking of gold liquidity are robust in those moments, not just when things are good. So they're the kind of things we're focused on. And I think it's in pretty good stead.
How do you, in this kind of environment today, maintain, let's say, efficient hedging without sort of over-reliance on external liquidity? I mean, you're doing a lot of great things. I hear it, but I mean, it seems like it's a situation or an environment that is still elevated risk. And uh, you and I spoke about this also in the summer, and you just said, when speaking to brokers, some some people had a great day or a great month.
Yep.
Others didn't. And obviously hedging is a very important tool in our industry, both on the retail and the institutional level.
Sure.
How do you maintain efficient hedging in this I would say kind of crazy environment?
Yeah. Look, it's definitely been more challenging than under sort of, I guess, more subdued conditions. But again, I don't want to sound repetitious here,
Sure.
but planning for these sorts of things ahead of time goes a long way. So, not just having single sources of liquidity, bank, non-bank ECN venues. We absolutely access a broad range of venues, including futures markets and other listed markets as well. I guess we're blessed in some senses because we have trading servers in 3 different locations.
Yeah.
New York, London, Tokyo. We centralize risk, which means that we're able to achieve a lot more netting across those 3 locations because we can centralize risk into one geographic location. And I think that stands us in very good stead.
Yeah.
And reduces our need for as much external liquidity sourcing. But regardless, in markets like this, particularly when there's, a very clear directional view from the retail market and ultimately our broker clients, you have to have some degree of comfort and confidence in those external hedge sources.
Absolutely.
And diversification, solid relationships that you've looked after and nurtured, not just when times are getting difficult, but when times are good, which means, yes, engaging in, those conversations with LPs and sharing volumes and flow and making sure that all relationships are strong. Those sorts of things set you in a good position for when things are more challenging.
It's great. Awesome. James, earlier this year, you said 23-hour trading for U.S. equities and ETFs. It's going to be expected to go live in early 2026. We know that Mr. Galinov and 24X have finally gotten approval. They've launched, I think, also 23-hour trading, equities trading in the United States.
Yep.
I wanted to ask, have your plans changed in any way as they've gotten approval and have launched their service? Has anything kind of changed in your roadmap and your plans or time to market?
Look, it has a little, but only a little. The main thing that I think has changed is that the traditional ATS venues, the alternative trading service, those non-exchange venues.
Yeah.
We have been, I guess, preferencing the arrival of not just the DTCC clearing capabilities and trade reporting capabilities, which are due to come online in Q2 2026 of next year. And once those DTC capabilities come online, the regulated exchanges will be in a position to execute their strategy to push through, whether it be 22, 23, or 24-hour trading.
Okay.
Some of them are making slightly different noises, but let's just call it extended hours for now.
Sure. Yeah. Okay.
So we've actually made the strategic decision to wait for the delivery of the exchange venue liquidity to come through.
I see.
Now, 24X has, as I understand it, been granted approval to launch the exchange.
Correct.
I don't know how far they've actually extended to 23, 24, 20 extended hours trading.
Yeah. That's still to be seen there.
It's still to be actually played out, that timeline. But, what I do think is that as that timeline materializes, it's probably going to congeal around Q3 next year, 2026. To Q4 at the sort of latest of the exchange level. And we've made the strategic decision to hold until that exchange liquidity comes through. The reason being, we've got a little bit more confidence in the quality of pricing and regulatory oversight when it comes from exchange sources.
Okay.
And we have in the past, without mentioning specifics, seen instances of those ATS services having substantial impacts to market data and execution capabilities. So for us, knowing that our broker clients rely on us as often their sole source of pricing, particularly for equity CFDs, we always need to ensure that we've got multiple sources of liquidity available to us. Comes back to that capacity planning you talked about. That said, we're very keen to push it out because with the launch of 16-hour trading that we announced in April this year, we have seen a significant increase in US equity volumes to the point where even though we've had that product live, the US equity CFD product live via API for 7 or 8 years now, we've experienced a near doubling in volumes on US equities since we launched the extended hours from the 1st of April to today.
Nice.
And what that tells me isn't that just there's interest there in signing on to the new brokers and attracting new customers, but for those existing clients of ours that already had US equity trading, their volumes are growing because it's not just volume in the pre-market or the post-market, even volume in the regular trading session, which was already offered, has significantly increased. That just shows more retail participation, more interest, more trading, more hedging, all of which is good for us. It's good for our clients. So, that 16-hour move has been a massive success. And honestly, especially being here in Hong Kong, we hear the demand from here in Asia. I've just come from Japan. I've just come from Korea myself last week. There is significant demand to push to that full 22, 23, 24 hours as soon as possible. So the day it's available from a regulated national exchange in the US, we will be there day one.
I think that's a really great approach, obviously. You don't want to, how do we say it in American English? Kind of lost my train of thought.
Jump the gun?
Yeah, jump the gun.
Jump the gun?
You don't want to jump the gun, and I totally hear you. I mean, if you have to rely on, I'm not going to say unreliable data or things like that or flow, then of course, it doesn't necessarily make sense, especially when a company like 26 Degrees, your clients expect a certain level of everything, right?
That's a very good way of putting it. Very good way.
Maybe it's a new Max. Maybe it's a new slogan for the company, a new brand slogan.
Expect everything. There you go.
You did mention we are in Asia, and I was actually going to be my next follow up in regards to this increased demand for U.S. equities. Like you just said, you're seeing it across Asia, Korea, Japan, etc. Are there any other regions where you're seeing these other regions driving sort of this volume, this demand?
Yeah, look, I mean, it's easy to say Dubai. There is a lot of activity. There's a lot of growth coming out of Dubai at the moment, no question, in our industry. But truly, the US equity phenomenon is a genuinely global phenomenon. I mean, it is something that really cuts across geographies. It cuts across regulatory landscapes. And again, it does come and is undoubtedly driven in some part by the strong performance of the US equity market. No question. But regardless of that, I think that what we're seeing is this globalization of understanding, especially if we step back to the retail traders, the ultimate source of, these trade volumes and, this interest, this engagement, the lifeblood of our industry. They're becoming increasingly familiar with these US names. They're, seeking only access to these stories and these trading ideas and opportunities. So I do think that at a global level, not just from any one jurisdiction, the growth in US equities will continue for quite some time. And, other asset classes going 23 to 24 hours is only going to increase that access, especially in places like Asia. So I think if you view this phenomenon from the point of an Asian-based broker whose clients are here for the first 8 hours of any trading day, this is just new revenue streams, new client acquisition channels. It's crucial. It's how they grow. And I think that story is only going to play out very strongly over the next few years.
You mentioned that you're seeing a lot of traction in Asia, the Middle East, and again, Asia, South Korea, Japan. I wonder, how are you seeing, differences in terms of client expectations and obviously the regulatory environments that exist in each one of these localities?
Yeah, it's look, client expectations are rightly and understandably quite high everywhere. Clients do expect a lot from their LPs, and I think us in particular, and we really do try and hold ourselves accountable to that level of expectation. It is fair to say that there is no level of expectation that is higher than in markets like Japan and Korea, these heavily regulated markets, where the regulators don't just take a broad brushstrokes approach to regulation or an ideas or a philosophies-based approach. It's very pragmatic. It's very technical in its application. So there are very specific things that need to be adhered to if you want to do business in those markets. But what's interesting, I guess, from a product design perspective and a product presentation perspective is how these different regulatory environments create different use cases for products. If we stay with US equities for a moment, in Japan and Korea, when we look at the opportunity for an extended hours US equities, the feedback we hear from clients is, look, this is fantastic. Our clients are going to have, their retail clients are going to have access to US markets during the afternoon and the evening, and they're really excited to be able to trade leveraged ETFs in the US during that time zone. If we switch over to Europe and we speak to our broker clients in Europe, there's still excitement about the extended hours US equities, but it comes from a different perspective. They're excited about the opportunity to be able to hedge some of their internalized risk during that time zone. So if you're a broker based somewhere in the ESMA region who has internalized some of this risk and is sitting on positions, especially when you've got negative balance protection requirements under ESMA, the ability to be able to hedge in more flexible time zones is a massive benefit. different use case, same product, but it's just interesting to see how those different regulations sort of really play out the use cases and the applications for progress and products and, product development.
Great. Awesome. To wrap things up, we've discussed pair CFDs before, but you've also expanded your product range with new index and commodity CFDs. And I wanted to ask for those products, where's the demand strongest right now, and how do you manage, let's say, or balance product innovation with risk and compliance obligations? Because we just discussed, there's different regions have all of these peculiarities or differences with it in terms of regulatory environments.
Yeah, for sure. Touching on your first comment there, demand. Look, for some of the new commodities products that we've launched, for some of the new pairs products, many of which are themselves commodity combinations, so gold, oil, silver, that's certainly been the focus for demand, unsurprisingly.
Yeah.
Geographically, that demand is being driven largely out of the Middle East, where there is a very strong commodities focus outside of just gold. I mean, gold's obviously a key commodity in the Middle East, but it is broader than that as well. A lot of the soft commodities, unsurprisingly, have quite strong engagement in the Middle East. So I think the Middle East for those sorts of products. In Japan, a lot of the equity-linked pairs have been quite successful. Again, US equity-linked pairs because of the familiarity with the names. But also, surprisingly, there are pockets of real commodity interest in Japan and Korea as well. Unsurprisingly, products like soybeans have a significant retail participation because it's a product that's known and familiar to them in the form of soy sauce. So,
yes, of course.
when you start to connect those very sort of somewhat obvious dots in some ways, you can start to understand that retail trader mindset. Now, when it comes to the regulatory side, again, look, there are different applications per market, but different regulators doesn't mean good product design needs to be thrown out, because you have to design products that ultimately are interesting, are understandable, and are, going to be tradable by retail traders. Then ensuring that they rightly fit into the correct regulatory regime in the delivery, that's more of a delivery mechanism, the how, the where, the when. And we do consider that very, very strongly because it's a crucial part of our growth. And when you operate in as many different jurisdictions as we do, regulatory environments, and sort of, I guess, cultural environments as we operate in, you have to consider that as part of the product design process. But it's something we do, I guess, really enjoy. I think that, that level of bespokeness with some of these products is something that, we try and use to differentiate ourselves as well. It's had a lot of success, so we're very fortunate for that. But also it comes from client feedback. We can't pretend we're the ones having all the good ideas. Often it's clients that do prompt us to look at different asset classes or products that they'd like us to add, design, build, whatever it might be. So, regularly we're doing different variants of certain products as well to specifically suit a client's commercial needs or regulatory needs. So there's always something to build.
Cool. Awesome. This wasn't on our list, but I've been hearing a lot of questions here at the Expo about predictive markets. Because you're a company that has been very innovative, again, with pair CFDs, right? Taking products, individual products that we all know, but then basically crossing them together and creating new products. What's sort of your take, maybe even personal take, on predictive markets? Because they're becoming very, very popular in, let's say, the United States and other countries. Let's forget about the regulatory environment, whether it exists or not for those type of companies, but from what I'm seeing, especially like in the United States, the Kalshis and all of these other companies seem to be growing a very large market share, again, with Americans, because now you can really basically bet on anything, right? Whether or not Donald Trump wakes up in the morning is in a good mood or in a bad mood, right? For example. What do you think about that?
Look, it is a brave new world. As a business, the predictive market and that participation is not something that we're sort of actively focusing on. I think as a general point of interest, it's something that all of us pay attention to.
Sure.
Do you know what I mean? I think you'd be naive to sort of turn your views away from these sorts of phenomenon. And look, I think in, financial markets, we use a lot of correlation analysis to form various workflows, various processes that we undertake, various pricing strategies. They're not so much predictive, but as data sets grow, and companies, whether they be brokers or otherwise, get, the storage capability, the analytic capability to run these large model sort of simulations, it's completely understandable to see how you'd turn from analysis of what has been to prediction of what might become.
Right.
I can absolutely see from a general interest point of view how those predictive markets have taken off. I mean,
Yeah.
they can be interesting. Does that mean we're going to participate in those sorts of markets as a business? No, it does not.
Sure.
But it's certainly, well, something we look at.
Cool. Awesome. Yeah. Well, James, thanks for taking the time to speak with us. It's lovely always to meet with you. Good luck the rest of the way. 2025 is coming to a close very soon. So I have to say happy holidays that are coming up to you and your family. Catch you at the next show.
Sounds very good. Thank you very much for having me.
Thanks a lot.
Appreciate it.
Cheers.